Have you ever looked at your savings account and wondered whether you're doing enough to build real wealth? Every month you set aside a little money. Maybe it's $100, maybe it's $200. Over time, your savings balance slowly grows, and that feels like progress. It feels responsible. It feels financially mature. Then one day you open your banking app and notice something surprising. You have $10,000 sitting in a savings account earning around 0.5% interest. After an entire year, you've earned only about $50. Meanwhile, everywhere you look, people are talking about investing, stocks, index funds, compound growth, financial freedom, and eventually a question starts to creep into your mind: am I doing this wrong? Because while saving money is important, saving alone rarely creates long-term wealth. And this is exactly where many people get stuck. They understand that saving matters, they know they should be putting money aside, but they have no idea how to make the transition from saving to investing. They worry about making mistakes, they worry about losing money, they worry about starting at the wrong time. If you've ever felt that way, you're not alone. My name is Alex, and I'm a financial advisor dedicated to helping people make smarter money decisions and build a stronger financial future. Before we get started, make sure to like this video, subscribe to the channel, and turn on notifications so you never miss future videos about investing, wealth building, financial freedom, and personal finance. Today, we're going to walk through the exact step-by-step path that helps you move from simply saving money to confidently investing it, without feeling overwhelmed and without putting your financial security at risk. Let's begin with something that might sound controversial. Saving money alone will almost never make you wealthy. Now, don't misunderstand me. Saving is incredibly important, but saving isn't the finish line, it's the starting line. Because savings and investments have completely different jobs, savings protect your money, investments grow your money, and confusing those two jobs is one of the biggest financial mistakes people make. Let's look at a simple example. Suppose you place $10,000 into a traditional savings account earning 1% interest. After 1 year, you'll have approximately $10,100. That's not terrible. Your money is safe and accessible. But now compare that to investing. Historically, the S&P 500 has generated average annual returns of roughly 10% over long periods of time. If that same $10,000 earned 10% during the year, it would grow to approximately $11,000. At first glance, the difference doesn't seem life-changing. It's only $900. But the real power isn't what happens after 1 year, it's what happens after decades. This is where compound growth changes everything. After 20 years, the $10,000 sitting in a savings account earning 1% would grow to roughly $12,200. The same $10,000 invested at an average annual return of 10% would grow to approximately $67,000. Same starting amount, completely different destination. And this is why the biggest wealth gap isn't usually between people who save and people who spend. It's between people who save and people who invest. The problem is that most people never make that transition. Not because they don't understand math, because they struggle with psychology. Saving feels comfortable. Investing feels uncertain. Money sitting in a savings account looks stable. You can log in tomorrow and see nearly the same balance. It doesn't swing up and down. It doesn't lose value on a random Tuesday afternoon. Investments are different. Some days they're up, some days they're down, and that volatility scares people. You might be thinking, okay, Alex, but I don't want to lose the money I've worked so hard to save. That's a completely reasonable concern. And it's exactly why the transition from saving to investing shouldn't happen all at once. It should happen in stages. Let's walk through those stages together. Step 1. Build a real emergency fund. Before you invest a single dollar, you should have 3 to 6 months of living expenses saved in cash. This money stays in savings. It's not investment money, it's not opportunity money, it's emergency money. Job loss, medical bills, car repairs, unexpected life events. The biggest reason people panic and sell investments at the worst possible time is because they need the money immediately. An emergency fund prevents that. Think of it as protection for both your finances and your peace of mind. Once that's in place, move to step 2, separate saving from investing mentally. This sounds simple, but it's incredibly powerful. Create 2 mental buckets. The first bucket is safety money, the second bucket is growth money. Safety money exists to protect you. Growth money exists to build your future. The safety bucket should remain stable. The growth bucket should be expected to fluctuate. Once you clearly separate those purposes, investing becomes much less stressful. You're no longer expecting investment money to behave like emergency money, and you're no longer expecting emergency money to generate investment returns. Step 3. Start small. One of the biggest myths about investing is that you need thousands of dollars to begin. You don't. Many investment platforms allow you to start with $50 or $100. The goal at the beginning isn't becoming rich overnight. The goal is building the habit. Because successful investing is usually less about finding the perfect investment and more about consistently participating over long periods of time, habits matter far more than timing. Step 4. Keep your investments simple. This is where many beginners make costly mistakes. They jump immediately into complicated strategies, day trading, options trading, speculative cryptocurrencies, trying to find the next big winner. But often the simplest strategy performs best. Consider index funds. Instead of trying to predict which company will succeed, index funds allow you to own small pieces of hundreds of companies at once. That means diversification, lower risk, broad market exposure, long-term growth potential. Simple doesn't mean ineffective. In fact, some of the world's most successful investors have consistently recommended low-cost index funds as the best starting point for most people. Now, here's something most beginners don't realize. The most effective investing strategy is also one of the least exciting. It's called consistency. Let's look at a quick example. Suppose you invest $300 every month. If your investments earn an average annual return of 8%, after 25 years you could accumulate roughly $285,000. Here's the remarkable part. You only contributed about $90,000 of your own money. The remaining $195,000 came from growth and compounding. That's the power of letting time work on your behalf. Of course, investing still comes with emotional challenges. Markets fall, news headlines become dramatic, experts predict disasters, people panic. This is where discipline separates investors from speculators. Think about it this way. Saving money is like storing seeds in a jar. The seeds are safe, but they aren't growing. Investing is like planting those seeds in soil. At first, it looks uncertain. You don't immediately see results, but given enough time, those seeds begin to grow into something much larger. Now you may be wondering, what happens if I start investing and the market crashes? That's actually a great question because market declines are normal. They've happened many times throughout history, and while downturns feel uncomfortable, long-term investors often benefit from them. When prices fall, your regular contributions buy more shares for the same amount of money, and when markets eventually recover, those additional shares can significantly boost long-term returns. This is why experienced investors focus on decades rather than days. They're not worried about what happens next week. They're focused on where they'll be 10, 20, or 30 years from now. So let's review the process. First, build a 3 to 6 month emergency fund. Second, separate your money into safety money and growth money. Third, begin investing small amounts consistently. Fourth, focus on simple long-term investments such as index funds. And fifth, stay disciplined and allow compounding enough time to work, because eventually most people discover an important truth. Saving money creates stability, investing creates growth, and when you combine both, you create the foundation for financial freedom. The earlier you begin that process, the more powerful the results can become. If you found value in this video, make sure to hit the like button and subscribe to the channel for more financial insights, money tips, and wealth building strategies. See you in the next one.